Hi, everyone. Welcome to Redefining Angel Investing, how anyone can get started today. I'm Bianca Caban, and I lead partnerships at Republic. Today, we're really excited to be working on this webinar with our partner, SheWorx. SheWorx is a leading global platform and event series that empowers 20,000 plus female entrepreneurs to build and scale successful companies. I'm going to go through our agenda, and then we'll get started. We'll have about 20 to 30 minutes of content, and then we'll launch into Q&A. If you have questions, you can feel free to start to ask them via the Q&A button at the bottom of your screen throughout the presentation, and we'll address them at the end. With that, I'll introduce our speakers. From SheWorx, we have Lisa Wang, founder and CEO. And from Republic, we have Caroline Hoffman, Chief Operating Officer. With that, I'm going to hand it over to Lisa to talk about our goals and why we're doing this today. Lisa?
Hi, everyone. Super excited to be here today and to see so many people who are interested in becoming angel investors. As a bit of context, the reason we're doing this is because of both SheWorx and Republic's commitment to closing the funding gap and getting more investment to diverse entrepreneurs. So when you look at the landscape now, despite the significant media attention that's being paid to the issue, it's clear that women still don't have a level playing field, because even though women-owned businesses comprise 39% of all businesses, they only produce 4.2% of all revenue. Women start with 6 times less capital when launching their businesses, and they continue to stagnate when they don't have access to capital, resources, and networks. So when you look at the venture landscape, women also only make up 7% of venture capital partners and only 22% of angels in the US. So on the investment side, it's also very lopsided. But thanks to networks like SheWorx, we're giving access to the right sources of capital, as well as to platforms like Republic. Everyone, regardless of their accreditation status, now has the chance to invest in vetted private companies with as little as $10. So our goal here is really to create a supportive environment for women to learn and ask questions, to dive into investing, and to get to parity in terms of numbers and provide everyone here with an actual way to support others. As a brief introduction to SheWorx, we are a global community of over 20,000 female entrepreneurs from across 7 cities, both nationally in New York, San Francisco, and LA, as well as internationally in Singapore, Tel Aviv, London, and Toronto. Over the past 3 years, we've led over 300 roundtables that focus on getting women access to the right skills, the right investors, and the right sources of capital for their types of companies. And we're focused on cultivating a really strong network of tech talent so women can get the access to founders, and women entrepreneurs can get access to the right sorts of talent. We host summits that bring together over 600 female founders and 90 investors, and our focus is on bringing meaningful relationships into the room so women can have a level playing field when they're pitching their businesses early on. And we've had really amazing success rates where we have over 90% of the female attendees schedule follow-on investor meetings. So later on, if you are interested in investing in female entrepreneurs in the SheWorx network, we'll have a form for you so that we can start sharing deal flow that you might be interested in. And now on to Caroline to talk about Republic and how they're democratizing access to capital.
Thank you, Lisa. Hi, everyone. My name is Caroline Hoffman. I'm the COO at Republic, and thank you so much all for joining. So as Lisa was mentioning, we both, SheWorx and Republic, really feel passionate about closing the funding gap, and I'll explain a little bit about Republic, and then also give you all an introduction. We'll jointly give you an introduction to what angel investing means, how to approach it, etc. So Republic spun out of AngelList in 2016, and for those who don't know, AngelList is probably the largest angel investing platform that is focused on accredited investors. And we spun out of AngelList with the objective of bringing the ability to angel invest to everyone, not just the wealthiest 5% of the population, and also to offer a new ability for startups to raise capital. Because then our rationale was, if everyone can invest, the types of startups that can get funded will probably look quite different. We take great care in vetting startups. So the deal flow that you see on Republic is probably only 10% of all companies we look at. So we look for truly investable opportunities. And our deal flow also, and we're proud to say that, looks a little bit different from the traditional Silicon Valley deal flow. So by middle of this year, we had roughly 45% of companies that had at least one female co-founder in their company versus 13% in traditional VC. And our investor base looks slightly different from the traditional investor base of a tech startup. So we have roughly 30% of women on an average deal on Republic. And we still believe that this is too little. We want to get to parity here as well, especially when it comes to backing diverse founders. So this is really about more women and trying to get more women to support startups and founders, to know about this asset class that is angel investing, and to make it palatable and approachable for everyone. Let's move to the next slide. So I'll give a short overview on like what is angel investing, and then Lisa and I will focus a lot on the question of like, how do I actually select the right startup or the right portfolio of startups? So angel investing at the most general level is a direct investment in a private company. It's an asset class like stocks or bonds, and in a balanced portfolio, you really don't want to allocate more than 5 to 10% of your portfolio to high-risk asset classes, of which angel investing is one. It is called angel investing, which is probably a more interesting name than debt or equity or stocks, because you become an angel, someone who helps and supports a early stage venture. You support them with money, but you're also one of the first believers in the company and basically see a company grow up. It is a high-risk asset class. There is absolutely no way around it. But it is also an exciting way to not just place some money, but make investments in people who you think can build great things. So next slide, I'll talk about what makes it difficult and what makes it interesting. So what makes it interesting is you're directly supporting founders and people you believe in. So you have the ability to participate in advancing new technologies, and you can be very early in brand new companies that may change the world. Imagine how some people may feel who were very early investors in, let's say, ride sharing or gene editing or Amazon or AI. So I think there is potential to participate really early on in transformative technologies, but it's also difficult. And I think there are three big things. The first one is, when you make an investment like this, it's not a liquid investment, which means you place an angel investment. In most cases, you will not be able to get cash back for at least a couple of years. And the typical horizon from seed stage, so the very first institutional or angel funding stage of a startup to an IPO, is 6 to 8 years, and it's getting longer actually. So your money is, in most cases, locked up or in the best case even, it's locked up for quite a while. And that's also why it's important to not put your life savings into this, but really reserve a very small portion of your savings for high-risk investments. The second thing is, these are private companies. They're new. There's not much data. You can't sit down and build a 10-year financial model and look at 10-year historical data and profitability and trends and all of these things that I've tried. Often you invest in a startup that just launched or that just has a prototype. So there's not much data, and it's a lot more about the team and the idea than it is about hard facts. And the third is, it's actually not that easy to find these deals. So most of you probably don't know 10 people, 15 people who are focused on fundraising right now. So sourcing these opportunities is both time consuming and difficult, and you should probably look at least 10 deals, 5 deals before you make an investment. So it's not that easy to source these opportunities. And a platform like Republic tries to tackle the deal flow question and also does diligence to do initial evaluation on the investability and the viability of the company. So what do you need to be a great angel investor? We like to boil it down to 3 things. And the first one I just talked about a little bit is deal flow and access. So Naval Ravikant, who is a little bit of the godfather of Republic because he founded AngelList, said you have to look at 100 to 1 opportunities for investments. Investment platforms actually change that because they already have highly curated deal flow. He also said you have to invest in 10 to 20 deals per year. And in the traditional model where the angel check is 25K or so, that's kind of impossible for most people. So Republic often has minimums of $10, $50 to make an angel investment. And that's how we are trying to make it approachable to actually have a diversified portfolio of angel investments. The second one is time commitment and capital. So there are different ways to invest in startups, and the most traditional one was the 25K per deal type of investments at the very minimum, and that's when people invest directly, or for example on platforms like AngelList, they lead syndicates. Platforms often for accredited investors like AngelList, but there are some others, obviously, have often minimums between $1,000 to $10,000. And then Republic and some other of the regulation crowdfunding platforms have lower minimums. And I think we have among the lowest minimums in the industry because we really believe in the democratization aspect. And we have sometimes deals that start as low as $10, $50, $100 per deal. And then the third is judgment. And that is really the most important part and the one we'll dive much deeper into in the next half hour or so, which is the 4 T's. How do you actually assess the opportunity to invest in a startup? And we like to boil it down to 4 things: team, traction, the technology, and terms. What's the deal you're actually getting? So we'll dive a little bit deeper into this later. Before I hand it over to Lisa, I want to give you one example. So full disclosure, Facebook never raised on Republic or AngelList or has no affiliation, as far as I know, with SheWorx. But we want to give you an example of how does great angel investing look like in terms of outcomes. So this is obviously an absolutely exceptional example. If you invested, Facebook raised, can we go back, please? Facebook raised $500,000 at $5 million valuation in 2004. And when they did their IPO 8 years later, so it took 8 years, they raised $16 billion at an $83 billion valuation. So what are the takeaways we can take from there? If you had invested $100 in that very initial seed round, when Mark Zuckerberg was living in a dorm, Facebook was probably just Harvard, and there wasn't much indication that this was going to be the thing, the way a lot of people, billions of people communicate in the world, and a huge advertising machine, etc. Well, if you had invested $100 back then with all the uncertainty around it, you would have received $350,000 in 2012. This is obviously an absolutely outstanding example, but what you can learn from it is a couple of things. One is even these investors had to be really patient and wait 8 years to see any cash come back. There's absolutely no guarantee of a return. Facebook could have failed. But if you make one great investment, and in this case, it was an extraordinary investment, you can have a lot of other startups fail in your portfolio. And this is really the reality of angel investing. For every startup that succeeds, you probably make 10 investments that go down to nothing. And so I think it's, as a startup investor myself, particularly important that you actually also like the company you're investing in, you like the mission of what they're building, and you know that there's a high risk that it will fail. So I think that is actually really important to keep in mind. So now let's move to the 4 T's. Lisa, I'll hand it back over to you.
Great. So if you are ready to dive into angel investing, the easiest structure to look at is what we call the 4 T's: team, traction, technology, and terms. So the biggest myth of fundraising is that a great idea should and will be funded. So the truth is that millions of people have ideas, and an idea that's executed incorrectly, without the right metrics, without the right team, without the right market, has a significantly lower chance of receiving the funding that it's requesting. So as an investor, the most dangerous thing is funding an underfunded startup. So you want to make sure that you assess carefully before you jump into investing in an idea that seems like it's a great concept in the moment, and actually take some time to go through the 4 T's. So the first one is team. This is probably one of the most important, because this is really about the person who's going to be driving the vision and making sure that people are executing. So the people, when you look at the founders, they need to be able to have the ambition and the conviction that they're going to build a really scalable company that's going to return 10x, 20x your money. And part of that comes from their track record of success in a career. So CEOs need to be a master of execution, and they need to be able to deliver and make their product win. So looking at that track record is really important. They have to have the necessary skills and understand the market better than anyone else. When you evaluate the CEO, you have to think about the fact that they're going to be the face of the business. And as such, they need to be able to carry themselves like that. And they need to be able to make tough decisions. So one thing to evaluate is, how do they make those decisions? The second thing is passion. It goes without saying that they have to be passionate about the problem they're solving. And one good way to do this is to really ask about their long-term goals. See why it is and what's really driving them at the core. Do they have the ability to convince people to follow them? Do they have the ability to communicate clearly and articulate a value proposition? And do they have a track record of demonstrating resilience? So one thing to think about is, what is the DNA of the company? So when you think about the DNA of the company, what that means is the founder has to have truly deep domain expertise in what they're building. So a great metaphor is if you think about successful restaurants. So the most successful restaurants in the world are run by chefs. And similarly, the most successful tech companies have to be run by people who understand technology inside and out. And the reason for this is because it's an obsession. The knowledge and ingrained muscle memory and the know-how to really do something. Because a lot of times you'll have founders who come in and they're non-technical founders trying to start a technical company. The problem is that they don't understand and have the domain expertise and that deep DNA to build and scale that sort of company. So the same way that a restaurant, the restaurant's DNA is chef-centric, if you're looking at a mobile startup, the founder must also be tech-centric. So, and finally, that just goes to vision, having a really audacious vision, having deep thoughts about marketing, sales, and growth, having a plan and a process for telling how they're going to get from point A to point B. The second thing is traction. Even at an early stage, it's important to look for quantifiable proof points. At this stage, both angels and VCs should be looking for the same types of proof points. As a business, founders need to be able to show enough that they can demonstrate that there's a repeatable need for their product or service in the market. And it differs between different types of companies. So first, if you're looking at a consumer company, what you need to look for is highly passionate and engaged users. You should be checking their monthly active users, their retention rates, both in the short term, 1 week, as well as 1 month. You should be evaluating their customer acquisition costs as it relates to their lifetime value. Usually it's good to see something about 3 to 5x LTV to CAC ratio. And then finally, the viral coefficient. So the viral coefficient is the number of new users that an existing user generates. This metric calculates the exponential referral cycle and essentially virality that accelerates a company's growth. So virality is the inherent incentive for customers to refer their friends or colleagues to their company. And word of mouth is something that just can't be replicated. So really look at who are the customers that love that founder's company, and do some background checks and ask those customers why they love it. Secondly, on the enterprise side, the proof points are slightly different. In this case, the financials are much more important. In enterprise software, you might just need a few proof points. For example, having 4 to 5 committed large beta users who are using their software and integrating it into their workflow is really not a small feat. So that alone may be more than enough to get you interested and potentially investing in that company. When you look at their sales funnel, how are they reaching out? In this case, you should be looking at not only month-over-month revenue growth, but also annual recurring revenue, because sometimes it's a slower cycle for enterprise companies. And finally, looking at who are the types of enterprise clients they're bringing in. If they're name brand, that means that usually it was harder to bring in because having those name brand users actually integrate the company into their workflow is something, it is testament to what the product is. And there's also deep research oriented tech like biotech, and but there are different metrics there, but we'll cover that in a different presentation. And the final thing that I'll be covering is tech and product. So again, understanding the DNA of the company, and does the founder really understand the DNA of the company and have deep domain expertise. But the questions you should be asking around innovation and vision is not only around passion, but is the problem even worth solving? So a lot of times founders will come up with great ideas that might really align with your passion as an investor, but sometimes you have to take a step back from that excitement and just actually ask, how big is that market? Is the problem even worth solving? Is it worth building a company around the problem that the founder is solving? Is it a valuable and innovative solution? And is there a product roadmap? So there's something called the 3 Ps, which is people, plan, and process. So they need to have the right people who are going to execute the right plan and have a process for achieving that vision. Because sometimes what you'll see is that founders have a crystal clear vision of what they want to achieve 10 years from now, but they haven't really thought through the step-by-step plan that's going to happen next month or next quarter that's going to get them from year 1 to year 2. So really dig into the timeline of how they're going to execute that product roadmap. The second thing is user experience. This is really important when it comes to stickiness. Is the product 10 times better than existing alternatives? Are there signs that people are coming back? What are they saying? The more data that you have on this, the better. And make sure that you also play around with the product, especially if it's consumer facing. Share it with your friends, see what their thoughts are. Ask people in the target market. never underestimate the ease in the user experience. And finally, the competition. Does the founder have protectable and patentable technology? Do they have some sort of secret sauce that is creating higher barriers of entry? So the higher barrier, the better. So all of these are really important to consider when you're looking at the tech and product, and if it does have a defensible strategy as well as technology. So to bring it from the hypotheticals into an actual case study, I'd like to talk about Court Buddy, which is a successful startup that came through the SheWorx network. And so Court Buddy is a legal tech startup, and they instantly match consumers with vetted solo attorneys at a flat rate. So they're creating incredible innovation in the legal industry, where you think about all the headaches it takes and the overpriced retainers for lawyers. So they're making that accessible and democratizing access to people regardless of their financial status. So Christina and James are the founders of this company. And when it comes to team, they both have deep industry experience in the legal industry, in marketing and creating platforms. So right off the bat, that means they've had experience understanding the pain points, both in the court system as well as the for people who are looking for lawyers. So they took it from their personal experience and looked at what was available in the market. And when they took the traction part, so last year, Court Buddy raised their first $1 million seed round, and Christina actually became the 14th ever African-American female founder to raise $1 million, which was a huge win for them as well as the SheWorx community. And this, just a few months ago, they closed their $6 million Series A. So now they're off to the races with $7 million under their belt. And what they did before and in between that time is that they made sure that their traction was on point. So they continued to grow 20% or a little bit more month over month. They made sure that they were keeping in touch with their investors, which is really important, giving them monthly updates about what was working, what wasn't working, new initiatives. So that's also something to think about as the founders are gaining more traction. How transparent are they with their investors? Are they providing monthly updates? So it's always a bad sign if a founder suddenly goes MIA or stops communicating. So make sure you have that transparency. That's something that Court Buddy did really well in keeping everyone abreast, even potential investors, not just their current investors. So that's what made a lot of the investors who weren't in this the seed round come into the Series A. And then when it came to technology, it's a really innovative platform, because if you think about the legal industry, there's always a loser. It's a zero-sum game, whether it's the lawyers, whether it's the courts, whether it's the client who doesn't realize they suddenly racked up a $20,000 retainer. So their move towards a fixed legal services is potentially extremely beneficial to an entire industry, and can completely flip the way that we work with lawyers. So in many marketplaces, people lose as people win, so it's a zero sum. But in this case, Court Buddy, there isn't anyone who's losing. The courts are gaining, the lawyers are gaining, and the citizens are gaining. So that's really how they made their product unique and innovative, and they made sure every single person who touches the platform actually has a valuable experience. So this was an example of a company that used the team, tech, and traction, and all those boxes were checked off. And now I'll pass it over to Caroline to talk about terms, the final thing you should be considering as an angel investor.
Yes, last but not least, let me wrap it up with terms, and I'll keep it quite brief because I think there are only two ways you can go about terms. You either spend 30 minutes on it, or you just go over it and say, just don't enter a bad deal. Just because it's an early investment, it doesn't mean that it's necessarily a great deal. And there are a couple of things to look out for. The first one is, what's the instrument that you're using to invest? Is it equity? Is it debt? Is it some hybrid between the two of them? And then the second thing is, what are the terms of the deal that you're entering into? So the terms of the deal are simple things such as, what's the value at which you invest into the company? So is that at a 2 million valuation? So is that that the company is valued at, or is it 20 million, or is it 200 million? And that should be somehow realistic compared to peers, competitors, the traction that the company has, the stage they're at, the money that they need, etc. So it needs to be in a reasonable proportion. In many cases, when you do an early investment, you also get a discount. And then another thing to watch out for is dilution and pro rata right, which means as the company continues to grow, do you get a right to actually keep your ownership stable, so to reinvest to keep your ownership stable, and then are there specific clauses preventing your ownership to get diluted too much? And then briefly on the types of instruments that are typical for angel investing, the most typical are a safe and a convertible note. The convertible note is debt. It has interest and maturity date. The maturity date matters because that's the date at which it converts into equity, which means you just have shares, straight up shares in the company, and those translate into a percentage of ownership of the company. The interest is usually less important on a convertible note. A safe is a simple agreement for future equity. We use a version of the safe called CrowdSafe on Republic. It basically rolls up the sometimes 1,000+ investors we have in a single campaign. And then equity, straight up equity, is actually a fairly uncommon or rare form of investments in the very early stages, just because, especially when you get a bunch of checks, it tends to complicate the cap table. It makes things unnecessary. You have to do a price round, so it makes things unnecessarily complicated very early on. So my parting thought on terms is basically, don't enter a bad deal and look at the terms. They can be a deal breaker. They usually shouldn't be. They can be somehow negotiated, usually by the lead of the round, but you definitely need to look at this, especially things like, does the valuation seem reasonable? What's the dilution? What's the pro rata rights? Things like that you should definitely be watching out for. So I want to give, Lisa just gave an example of CourtBuddy. I want to give an example of a company that recently raised on Republic. So Amber, the female CEO and founder of Indemnis, runs a drone parachute startup based in Anchorage, Alaska. We love this deal. She is the woman who has raised the most in crowdfunding in 2018. She raised over $600,000. And she raised it from over 1,000 investors. Here is the terms that, or the things that are important in terms of the terms that she raised at. She had previously raised $3.5 million. So that was not a small number of amount of money that she has raised before. She made her minimum investment on Republic $100. She raised at a valuation cap of $25 million, which means that if you invested in the Republic campaign to make a return, you would hope that she is selling or IPOs at a valuation of more than $25,000. And then she did not offer a discount, which at her stage is fairly expected or reasonable, because she had already raised money before, etc. So that was Indemnis, great company. If you want to check it out, they're closed now, but really successful company that raised on Republic recently. Let's go to the next slide. So a couple of very practical tips to wrap it up. Set aside an annual budget. Don't absolutely please don't set aside more than what you can afford to lose, especially in the initial stages of just learning how to angel invest. You'll probably not pick 5 winners in a row. We all wish you that, but that's probably not going to be the case. That's certainly not the case as I set out to invest at a small scale. Sign up for multiple platforms and just get familiar with the deal flow. Look at it, get used to reading pitch decks, reading the deal pages, engage with founders on Republic and SheWorx events in your area. Ask questions, understand their goals, motivations. There's a great benefit in pattern recognition when, as you practice and become an angel investor. You can sign up. Here's the link, and we can send it later by email also on Republic and on SheWorx to see diverse deal flow. And in the odd chance that you might be looking for a job, I think there's no better way to learn about tech than working in tech. So AngelList has probably the largest tech jobs postings overall, but definitely explore it. If you're interested in tech, why not try to work at a tech startup or even a larger tech company? And then we'll be providing on the next page a long list of resources, but just reading about tech on a regular basis will just get you familiar with the jargon, will help you understand what industries are trending, how fundraising trends are going, and that's definitely a valuable resource. Can we go to the next page, Bianca? So our newsletters, ABC, A16Z, the Andreessen Horowitz podcast series, term sheet, product hunt, CB Insights, pitch book. There are lots of interesting ways to read more about tech. With that said, thank you very much. Please check out Republic and SheWorx. If you want to email me, it's caroline@republic.co. Feel free to reach out to us with any more questions, but let me now open it for Q&A. So I saw one question from Alberto. Thank you so much for joining. You said, in your work and personal investments, how much time do you usually spend in terms of percentage of total diligence on each of the 4 T's? That's a really good question. I can tell you what we see on our platform. We see anything from people spending a couple of minutes and investing $50 to just give it a try and they like an idea, to people coming back to the deal page 3 or 4 times and spending hours on it. I would say if I personally take interest in a startup, I will at least spend a couple of hours looking at the market, the competitive environment, etc. It also depends on like who is referring the deal. Do I trust the source of the deal? Is someone who I know as a great angel investor investing in it? So in angel investing, and in VC, there's the notion of following. So are you following, or are you fully making your own decisions? So it really depends. It really depends on how big that check is for your total wallet size as well, right? So how much money are you putting at risk? But I would, even just for educational purposes, recommend you spend a little bit of time on it and familiarize yourself for at least an hour, a couple of hours with the deal. There are a couple of questions about the presentation. We're not sharing the presentation as a whole. We have a similar webinar that we did a couple of weeks ago that I think we have a recording that we can share. And then we have a series of blog posts about the 4 T's that we've published on our blog, and we can circulate that. Later as well. Lisa, do you want to take one more question? Okay, I can continue answering a couple of these questions. So here's someone asking, how are some key pointers to assess that it is a reasonable valuation? So I would look at a couple of things. One is, how does this valuation, so the very simplest way to think about valuation, and it's probably a crude generalization because there are lots of more things going into it, is is there any way a company would sell at that current value right now? That's how I like to think about it. Like, do I think that this idea in its form can sell for $1 million, $2 million, $5 million? Usually the idea is like, yes, maybe they would actually buy the team plus the idea for that amount, even if they haven't launched, right? The second thing I would look at is, how is the valuation of companies in that industry? So are there competitors or other players in a specific industry that are a little bit further ahead? What are the valuations that they have raised at? And third, I think I would look at, how does the valuation stand with relation to any types of projections that the company is making, or any type of traction that they have. And the traction doesn't always have to be revenue. It could be the number of followers or pre-orders or users that they have acquired, even if it's an app, for example, and they haven't monetized it. So I think all of these can be, Lisa went through that with traction, these can feed into the valuation. And then last but not least, the valuation is typically set by the lead investor. And the company usually will say, we're planning on raising on X. And then the lead investor will say, this is a term sheet, or the lead angel, and I'm suggesting to invest $100,000 at Y. And so it's a little bit of a negotiation. If you're coming in at a small investment amount, you won't be able to negotiate the terms, but you should definitely get comfortable with a valuation, the valuation. How do you make sure your idea is protected on all of these platforms? So I think the most important, so it's a good question. You can and should disclose on these platforms what you're comfortable disclosing. And usually the companies that are raising on these platforms are live. They are out in the market. They're selling to customers. I would say 80–90% of companies raising on our platform are direct-to-consumer companies. In the case of Indemnis, for example, that does parachutes for drones, she definitely did not disclose all her IP, and I don't think that that's unusual. So a founder can decide what type of information they want to hold on to and what type of information they want to disclose, so that angels understand that there is true IP and a really genius idea behind it. So it's a little bit of a fine line. I think whether it's a public raise on a platform like AngelList or Republic, or it's a private round, that risk is always there, because the VCs also see deals from competitors, etc., and might be close to them. So you're always running that risk. But I think it's about this balance of like disclosing enough that it actually comes across as truly unique and you're convincing someone that you have IP, and not laying everything open. So what's the usual timing for safes to convert into equity? The usual timing for safes to convert into equity is, so our safes can vary in terms of the exact terms that the agreement of a safe has. The safe on Republic converts at an exit, so whether that's an acquisition or IPO. So it's similar time horizon to what I laid out in the Facebook example, in the best cases. In some cases, there might be an acquisition much earlier, there might be an IPO 12 years down the road, or there might just not be anything. The safe that we have on Republic, because it often rolls up hundreds or even over 1,000 investors, does not convert into equity before that, because otherwise a founder is stuck with having 500 names on their cap table, and there is no clear benefit for an individual investor to be on the cap table with $100 earlier, rather, because the outcome is what they care about is getting paid out when there is an exit event. Let me scroll, so some are more. There were 2 questions about dilution and discounts. We're going to point you to a blog post that we published on VC Math. I think that that is written by one of our team members who is a much more active and angel investor, and will be able to give you a written and much more nuanced and elaborate response than I would probably do this topic justice. So we'll point you to that. Are there any more questions? Let me scroll. I don't see any. Is anyone typing here? Great. So if you have more questions, please email us. For me, it's caroline@republic.co. Sign up for Republic, sign up for SheWorx. We really like that you all joined. We really care about this topic, and so we hope to see you on our platforms, and please feel free to reach out to us at any time. And again, thank you very much for joining. We had a great attendance today, so we're very happy with that. Thank you very much, and bye.